So before we go back to the topics of modeling market dynamics using our IRL-inspired framework, I would like to go back, as I said, almost to square one in finance and talk about one of the most famous financial models, namely the geometric Brownian motion model, or the GBM model. This model was proposed by Paul Samuelson in 1965 as a way to improve on a specific deficiency of the previous model of Louis Bachelier from 1900. Bachelier proposed a Brownian motion with a drift as a model for stock prices. But prices in such model can become negative, which is a problem with the model. So Samuelson suggested an improvement in the form of the GBM model that is shown in equation 1 here. We can view it as a model for the stock value xt with a linear drift function f of x given by xt multiplied by a sum of a risk-free rate Rf, alpha signals zt with weights w, and a noise term with intensity sigma times xt. Now, the difference with the arithmetic Brownian motion or ABM model of Bachelier is that in the ABM model, both the drift and the volatility terms are constant. Now, unlike the ABM model of Bachelier, the GBM model only admits positive values for the stock price xt. And a simple way to see it is to know that the GBM model is equivalent to the ABM model for the log price instead of the price. And as the logarithmic function is only defined for positive values of its argument, this implies that the price in a GBM model can only be positive. So the price in the GBM model cannot be negative, which is good news. And now I would like to show a discrete time version of the GBM model that we will need going forward. And this is really simple. We just replace infinitesimal increments by finite increments and regroup terms. And this gives us equation 3 on this slide. So it simply says that the growth in time step delta t is linear with rate r equal to a deterministic part Rf plus Wz plus the noise term that is proportional to Gaussian white noise xi. We can also equivalently express this equation as an equation for a new value x of t plus delta t as shown in equation 4 here. Now, either in a taken either in a continuous time formulation or the discrete time version, the GBM model is one of the most popular models in finance. It's used in many financial models. Most famous ones include the capital asset pricing model, or CAPM, of William Sharpe, and the Black-Scholes model. The GBM model is simple and highly tractable, which are probably the main reasons it still remains the main power horse of modern finance to these days after it was proposed in 1965 by Samuelson. Yet, its simplicity notwithstanding, the GBM model has a large number of well-documented deficiencies that go beyond a mere fact that it does not fit the market quite well. So let's go over these problems with the GBM model one by one. First, the GBM model does not incorporate defaults or market crashes. A bit more generally, it produces very small probabilities of large market moves. When portfolio managers talk about month-long periods of 20 sigma events computed with the GBM model, it appears quite clear that something is wrong with the model itself. And third, the GBM model does not include effects of market friction, such as transaction costs or feedback effects from trading. Fourth, equilibrium market models such as GBM or the Black-Scholes model assume that a market is an isolated system without an exchange of capital or information with an outside world. And this is hardly a realistic assumption, of course. And finally, for completeness, I would like to mention inconsistency of the GBM model with various price patterns in real financial markets, such as short-term autocorrelations of price changes, volatility clustering, stochastic volatility, and so on. And I say here for completeness because even usually the last class of problems with the GBM model is considered as main problem or main class of problems with this model. Our focus here will be in fact on the other four deficiencies of the GBM model that I mentioned before. Now, of course, all these deficiencies of the GBM model are well known, and researchers proposed many possible extensions or generalizations of this bona fide model. And if we generalize a bit, we can classify all these models into three major classes. The first class of models focuses on the prediction side and tries to improve on a set of predictors ZT. And this would be a core objective of researchers that hunt for alpha signals for quantitative trading. Another and related approach would be to consider nonlinear dependencies on predictors ZT. And such approaches are often pursued with machine learning models such as, for example, support vector machines or neural networks that we talked a lot about in this course. And the objective there would be the same as in the first class of approaches, namely to improve the predictive power for better trading. The third class of extensions of the GBM model focuses instead on modifications of the noise term. This approach is pursued in methods based on risk-neutral valuation and used in particular in derivatives pricing. With methods in this third class, the volatility or noise term can become a different function of the state xt and might in addition become stochastic itself. And in this later case, we obtain a stochastic volatility model. Now, the common theme between all these approaches is that they all preserve linearity of dynamics in the state variable xt. But in fact, as we will see in the next lecture, including nonlinear effects in xt may perhaps be more important than such linear modifications of the GBM model. And as we will see later, this indicates that in a sense we also need to go beyond purely data-driven machine learning and reinforcement learning approaches or traditional financial factor model approaches when constructing better dynamics for stock prices. To this end, we need to rely on other models and theories. And it may sound a bit paradoxical after we spoke so much in these lectures about data-driven and model-independent approaches to talk again about models. But a little guarded or maybe not so little guarded truth of machine learning and data science is that you cannot proceed in a completely model-independent way if you want to build something practically useful. And in the next video, we will see in what sense we can do that.